In chapter 22, we are going to cover concepts in responsibility accounting, using flexible budget, developing and using standard cost, traditional variances calculations for monitoring cost and efficiency of the management and business operation, and the balanced scorecard approach. So technically this chapter 22, again, in a kind of regular managerial accounting books that you have to pay for those, it will be in 2 chapters. So most of these chapters that we cover technically are 2 chapters in regular books that you have to pay, and they teach in managerial accounting. In this ebook, those chapters are like combined most of the times, covering 2 chapters of regular book. So it's a good chapter, a lot of information inside. So let's don't waste time and see if we can go and do a thorough review on this chapter 22. And the good thing is on every page, normally we have a lecture video, which definitely you need to watch those, read the book. I'm trying to see, okay, what is the centralized decision-making? It is talking about the business style where top leaders make and direct most important decisions. That means the power of making decision is centralized at the top of the chain by top management. However, decentralized decision-making is a business style where top leaders concentrates on strategy, overall strategy of the business, and leaves day-to-day operation to decision-making tasks to lower-level personnel, because they believe lower-level personnel, they are dealing with the problem face-to-face every day. So it's better for them to learn and practice and manage those minor things on a daily business operation themselves. So top management, they don't have to get involved in every single thing and every single business decision-making. So there are responsibility centers, which those are the part of an organization under the control of a manager. That means those sections of the business, they are responsible for a specific type of expenses, and they have control on those expenditures, let's say, or even revenue in some cases. So, for example, cost center is an area of responsibility under control of a manager who is responsible for costs incurred within the unit. The unit generally has little revenue function. So, for example, accounting department. Accounting department in a company is a cost center, because accounting department is not generating any revenue. The generation of revenue comes from the business operation, let's say manufacturing t-shirt. So accounting is just doing what accounting department is doing, taking care of payroll, bookkeeping, accounting, financial statements, those type of things. So that's a cost center. They can control the cost of accounting department, but they have no control on cost of anything else, or the cost of, or the increasing revenue or whatsoever. But we have also profit center. Profit center is the business unit that has the control over both cost and revenue, and is therefore evaluated on the profit outcomes. So the profit centers, it is technically the core of the business where they operate, provide goods or services, and they create revenue. So profit centers can control revenue and they can control expenses. But cost center cannot control revenue, can control the cost in that department, but not the revenue. Okay, we have another center in a business, which we call it investment center. It's a unit where managers are accountable for cost and profit outcomes, including consideration of amount of capital that is deployed to achieve those outcomes. So investment centers, they are thinking about, okay, where should they invest? Should they buy this new equipment? Yes or no? And why should they buy this new equipment? How much profit that new equipment can generate? How much expenses can be avoided because of that new machinery? So investment center has control on expenses, on revenues, to influence those, and also to make a decision on where the investment's supposed to go and where they need to invest in a new location, new machineries, new equipment, new hirings, and so on and so forth. Okay, so here says operating income divided by sales, that gives you profit margin. Yes. So what is margin? Your income divided by sales. What percentage of income is coming from sales? So sales is your denominator and operating income is at the top. So operating income divided by sales gives you margin. Yes, profit margin. Sales out of divided by average asset, it gives you turnover. That means how much of every $1 of asset can turn over into sales dollar. So one more time, how much of every $1 of average asset can turn over into sales? And that gives you the turnover. Now, if you multiply margin times turnover, that's return on asset. Now, for me to remember this, I easily remember return on asset. Return is profit on investment, right? Return on investment. So return on investment, that means how much profit you have for every $1 of investment. So return on investment, or ROI, is a model consisting of a margin component, operating income over sales, and turnover component, which is sales over average assets. Those two cells will wash away from top and bottom of the equation. So it will reduces to being operating income divided by average asset. And why we say average asset? Because operating income belongs only to 1 year, right? Let's say from January through December. But when you put an asset from the balance sheet into in this equation, the asset will be only on December 31st. And that doesn't make sense because operating income is for the whole year and your asset is just for 1 day. No, you have to convert your asset to an average of the whole 12 months. So it is an apple to apple calculation. So operating income divided by average asset, which is beginning asset from last year balance sheet plus this year asset from the balance sheet, divided by 2, you get the average. Okay, here says, let's read this part. It says a prudent manager who is to be evaluated under ROI model will quickly realize that subcomponents are important. ROI can be improved by increasing sales and reducing expenses, right? And why? Because if you increase sales and reduce expense, your return, which is your net income, will go up, and or decreasing the deployed asset. Or if you, again, you want to increase your ROI, if you reduce the amount of average asset invested in the company, that will also increase ROI. And managers who get bonus and evaluated on ROI, they really like to either increase the profitability of the company or reduce the average asset balance. So the DuPont approach encourages managers to focus on increasing sales while controlling costs and being mindful of amount invested in productive asset. Disadvantage of ROI approach is that this is very important, some profitable opportunities may be passed by manager because they fear that potential dilution of existing successful endeavors because of increasing the asset. So what I'm saying is, look at here, it says return on average assets, right? Return on investment. So if you add a brand new equipment, that will increase the denominator, which is average asset. Where's the formula? Right here, average asset. You see the denominator will go down. Okay, so if I will increase. So if the denominator is increasing because of new equipment, then the ROI might go down a few percentage. However, if you look at the dollar amount of the additional revenue that comes into business, yes, might the dollar amount goes up, but the ROI goes down because of that new investment in new machinery. So in that case, if you give bonus and evaluate managers only based on ROI, then managers will say, the hell with that new equipment. We're not going to buy it. We're not going to invest that into that new equipment because that will reduce the ROI, even though the dollar amount of profit goes up by some dollar, but my ROI is going down, then my bonus will go down, and I don't like it. So that is the part that you should not only reward and provide bonus and evaluate your managers only based on the ROI. Okay, so let's see. Let's see, case study. So here shows kind of a picture that a CEO here is kind of controlling the VP of operations, has control on VP of finance and VP of real estate, and then let's say VP of operation has procurement management, that means purchase management, store management, catering management. So those are also, has some other supervisors here and there. So this blue color looks like it says indicates profit center. So those locations are like profit center. Cost centers are centers that they have no control on the cost, but they have no control on the profit, but they only control the cost. And let's say combination colors indicate multiple evaluation bases. So it looks like this is a combination color, kind of. Here is also a little bit of combination color. Interesting. Anyway, so let's move on. Let's see. So we have a reporting here. Okay. So here is the actual result of operation. They had total $2.5 million of sales, which came from burgers, fries, and drinks. However, the budget for this store location A was $2,525,000. They were thinking the burgers will bring about 43%, fries will bring about 22%, let's say, drinks about 35%. So this is the budget, but this is what actual happened. And here, if you compare to each other, you can see the variances. So here, the variances, the actual sales from burger was less than budget sales, and that was by 100,000. That's why it's in red. However, let's say the budget for fries was 550,000, but the sales was way more than that, 50,000 more. So that's a positive. 875,000 for drink. That's the budget, but we sold more. So that was 25,000 positive. So you end up by being bottom line $25,000, in the variances in regards to sales. How about expenses? In regards to expenses, we were budgeted for $505,000 for food costs, and we end up actually having $475,000. That means 19% of total variable expenses. So our food cost was like $30,000 less expense, which is here $30,000 less expense than 505 as a budget. But other variable expenses was for 200,000, and we end up by controlling very nicely on that part too, and we end up with 175. So that's $25,000 less than budget. Again, in regards to expense, those are good stuff. Okay, those are good minus numbers. You want to be minus in regards to expenses, right? You want to save on expenses. You don't want to. You want to be either equal to your budget or below your budget in regards to your expenses. Anyway, the contribution margin, as you see, was sales minus variable expenses. It was $1,850,000, and minus traceable fixed expenses of 1.1 million. So gave us actual margin of $750,000. But in a budget, we were thinking that our contribution margin will be about 1,820,000, and minus fixed expenses, it will give us a margin of 720. So even though in the budget we were thinking about $720,000 margin, but we end up with $750,000 margin, which is $30,000 over budgeted margin that we had in the budgeted results. So here, as you see, if you look, here is negative $25,000 in regards to sales, but here is negative $55,000 in regards to saving on the expenses. So here is, we didn't do good on the burgers, but here we did good in regards to saving on variable expenses. So that's why we end up by having $30,000 contribution margin. Okay, So that's so good in regards to looking at the store location and comparing the budgets with the actual results as a form of like a manager. Okay, so let's see what else we have here. So this is performance report for all stores, location A, B, C, D, and E. And you see every location, like this restaurant, has a few, standard budget, like 2.5 million here. If you look in number A, is actual results. I mean, 2.5 million actual results for location A, and ending by having a margin of 750. And also that happens, that's location A, and having a margin of 750. But actual results of location B is also here. Location C, location D, and location E. So as you see here at this point, like looks like a location E is like 500,000 in the negative area, but location D, C, B, and A, all of them has a positive margin. Also, there is a common fixed expense that is not traceable to any of those locations. You can call this as headquarter expense or anything that is related to all those locations, no matter which location you are looking at, that's not traceable. So that's why we have this $1.5 million as separate fixed cost, and we call it common fixed cost, and we deduct it at the last moment. The fixed traceable costs are here that it's traceable to the location. The traceable fixed cost might be eliminated if you eliminate, let's say, location E. But if you eliminate location E, you will not be able to eliminate common fixed expenses. Okay. So let's see what's in this picture. So here is the operations from stores and catering. So every location has some operation that is sales of inside the store or providing catering in the outside in clients' homes, let's say, or outside business locations, somewhere outside of the store. So it looks like we have here sales, and we have variable expenses. Okay, so sales minus variable expenses gives us contribution margin. I got it. Less traceable fixed cost. So for stores, we have 9.5 million traceable fixed cost. And for catering, we have 7 million traceable fixed cost. And for procurement is also 1.2 million traceable fixed cost. Procurement doesn't generate any revenue, but it is a cost center, so it has some cost. It's not a profit center. Those are profit centers, right? But procurement is not a profit center. So it just has some fixed expenses. Bottom line, the traceable fixed expenses combined is 7.7 million, 17.7 million. Okay, so after we have contribution margin minus traceable fixed expenses, we get the unit margin for the stores, 2.3 million, and also unit margin for catering, which is about 3 million. And we have also traceable common fixed expenses, which is 1.3 million. These traceable common fixed expenses has nothing to do with stores. You can't trace it there. It has nothing to do with catering. You cannot trace it there. It's something that belongs to the whole business, and you call it common fixed expense. You deduct that at the last moment, and you get a profit margin of 2,923,410. Okay, so this was based on, let's say, store locations, and here was based on stores with combination of catering. So those are stores, those are catering. So if you look at the stores, the store margin here is $2,334,050, right? So if you look at the store's margin, yes, it is $2,334,050. So this one column of stores, as you see, this just one column of stores. How do we know, let's say total sales is 16 million. How do we know variable total is 4 million? How do we know unit margin is 2.3 million? Because of this report. So because of this report, we know that our store margin is 2.3 million. Make sense? Total sales is 16.4 million, right? For all these locations from the stores, 16.4 million. So that 16.4 million is right here. Total variable expenses is 4.5 million for all stores combined. And that goes right there. So this cell equals to that cell. Enter. Got it? And then you deduct this from each other. You get a contribution margin of 11.8 million, which happens to be exactly same as this one, right? And then you have 9.5 million traceable fixed cost. That 9.5 million traceable fixed cost comes from 8 million here and 1.5 million here. So this traceable fixed cost equals to 8 million from traceable fixed cost for the stores and plus 1.5 million here of common fixed cost for stores. Total traceable fixed cost is 9.5 million. Minus contribution margin gives us 2.334. 2.334 million. Make sense? So then we add the catering also, which is another set of units of profit center, and that brings us unit margin of 3 million and some change. But procurement, that's not a profit center, it's just cost center, and that has a fixed traceable cost of 1.2 million, which is, it's a cost center. That's what they do. They just bring cost. And common fixed expenses are 1.3 million for combination of this operation. So that will be deducted from 4.2 million, and that will give us overall operation margin of 2.9 million for the whole business. Okay, so Here says the CEO would have access to all reports, as we just went over, from within the organizations, but would mostly focus on reports from each vice president. Also, management will tend to focus on areas where corrective measures are necessary. This is generally referred to management by exception. And management by exception, it's a management focus of attention on areas where corrective measures needs to be done, and it looks like it's necessary to correct something. That's good. Traceable, okay. The traceable fixed cost that would not exist if unit under evaluation ceased to exist. When you say traceable fixed cost, that means if you eliminate that unit, that fixed cost will go away. However, common fixed costs, as I said already, fixed costs that are incurred to support more than one business unit. That means if you eliminate any of those business units, still that common fixed cost will stay. So if there is any unit margin, that unit margin is gonna be very helpful to pay for common fixed costs. So for flexible budget, you need to understand that flexible budget is necessary because your static budget cannot help you to understand how you are doing it. If you are doing good in your business in regards to actual results, or you are doing worse. So in order to understand it, your static budget needs to be converted into flexible budget to be equal exactly as your actual results. And then you see about your expenses and to see how you are doing, where is the negatives, where are the positives, and compare apple to apple. Okay, so here in this example, let's look at it for a point of understanding. Here we have 100,000 units estimated budget for this business, which is a static budget. And in reality, we see that the actual units sold, let's say, was 105,000 units. So it looks like actual is different than the budget. And then here you see, oh, your direct material is higher. Yeah, it will, because your actual units are higher. So you cannot compare to your budget. It's useless. Your direct labor is higher. Okay, yes, it will be higher. How much, I don't know, but it will be higher because your units production is higher. Same thing in overhead. Yes, it will be higher. So these numbers here that you see, it's kind of useless, even though you can see what's the different variances, but you cannot blame anything. You cannot be happy about anything. You cannot be, concerned about anything because you are not comparing apple to apple situation. Okay, so bottom line, you get some results, but you cannot understand that much about what is exactly going on. However, if you convert your static budget to a flexible budget, then your expenses can be compared, and your variances will be very meaningful. So you have to convert these expenses. In order to convert those expenses, you have to know how much direct material you need to spend for every 1 unit of production. So those details probably is written somewhere here. And if not, that's okay. So direct material, I can easily understand from here, direct material is $100,000 divided by 100,000 units. That gives me $1 per unit. For direct labor is $50,000 divided by 100,000 units. That gives me 50 cents, I believe, right? Per unit. And variable expenses is $150,000 divided by 100,000, and that is like $1.50 per unit. So easily you can calculate your variable expenses based on units, and then use that information here to create your actual budget. So direct material is $1 per unit. Direct labor is 50 cents per unit, I believe, or something like that. Yeah, 50 cents per unit. And variable factory overhead is $1.50 per unit, and $1.50 per unit times 105, I believe, ends up to be $157,500. So you create a flexible budget, and then you start comparing. And now you say, okay, 105 minus 105, that's 0. But the flex budget was 52,500, but the actual was 53,000. So 53 minus 52.5, that's minus $500 unfavorable variance. Unfavorable variance. In regards to factory overhead, you were $2,500 favorable variance, because the flex budget says 157, but you end up with 155. So that's favorable variance, $2,500. So total variable expenses is $2,000 favorable. And the factory overhead was budgeted for 205, but actual was 200. That's another $5,000 favorable variance. So total favorable variance in comparing your flex budget with the actual results is $7,000 favorable. And here are these calculations that I was trying to do without a calculator in my mind. Here we go, those are the details. Got it? Okay. Now what? So you have to evaluate results and understand that what was good to continue and what is wrong, so you can focus over there a little bit more and make sure you don't do that way again, and improve your cost some way, somehow. Improve your results and spending, control the spending some way, somehow. So that's about evaluating, and then you plan to do something about it. Okay, let's see, what is this? This is a flex budget again, but for different amount of production. So sometimes you create a flex budget just in case. You say, okay, if we produce 80,000 units, This is the total manufacturing cost if you do 90,000 units. And you know already how to do it, because 80,000 units times $1 for direct material times 50 cents for direct labor and times $1.50 for factory overhead. And you can easily calculate those and prepare this flex budget so you can have an overall understanding of if you produce more units or sells more unit, whatever, in your manufacturing cost would be around what dollar amount in regards to your possible outcome. And your final idea is to increase the operating efficiency of your business by looking at the results, having multiple flexible budget scenarios, having an apple-to-apple comparison with a flexible budget, which is exactly. So let's say if your actual units was 106,300 units, then you have to change your flex budget to 106,300 units. So you can compare it apple to apple and evaluate what was good, what was bad, and what should you do about it. So we have some standard cost. It's a measure of what costs should be incurred to achieve that observed output. So normally you have some kind of standard cost for your business operation. Let's say you know how much material, direct material you need. Let's say $1. You know how much direct labor per unit you need to spend. Let's say 50 cents. You know how much the overhead is per unit, let's say $1.50. Those are your standard costs. Now, you're probably not gonna be exactly in that area. Sometimes you buy direct material from somewhere else. Market is changing, the vendor is changing. So those costs might change. Labor situation is changing. Again, those costs can change. So you have a standard cost, but you have also an actual cost. And now you need to understand and evaluate what went wrong where exactly. If you say just the total cost is less or more, that doesn't help anyone. You need to say the total cost of direct material was wrong, was higher, let's say, which is good, but still doesn't help anyone. You have to say why that direct material cost was high. You need to find out what was exact issue in regards to increasing in direct material cost. Was that about, let's say, the quality of direct material that you purchased and used in your production? Or was that the price of the direct material that has been increased? Because sometimes you might buy a cheaper material, that means lower price, but when you look at your direct material cost, it is more than before, more than standard cost. And you say, wait a moment, that doesn't make sense. How come I'm buying cheaper material, but now all of a sudden my direct material cost is higher? That's impossible. But the answer is no, it is possible. Why? Because yes, you bought less expensive direct material, which your purchase manager was so happy about it and so proud about it. But guess what? The quality of the material was low, so you end up by using more material to achieve the goal that you want to achieve. So yes, you paid less money, but you used more material. So the quality of material is not good, even though the price of material. So you have to find out go very deep into your numbers and find out the main root reason of the lack of performance in regards to controlling cost, let's say. Okay, so I talk about that a little bit. So this is talking about achievable standards, ideal standards. So those are good stuff to know. So standards that takes into account normal spoilage and inefficiency intended to allow workers to reach the established benchmark. That's an achievable standard. Ideal standard is a little bit more picky. A standard that could only be achieved under perfect operating conditions. Such standards are rarely expected to be achieved because it's just ideal, but it's very hard to reach. Okay, so let's keep going. Okay. Here is the variance analysis, and this is where I was focusing on the last page to explain why you need to look at this variable results and analyze them properly so you understand if the situation is good or bad, favorable or unfavorable, and then understand what's the reason of it. So let's look at the direct material variance evaluation and analysis. So material price variance is a variance that reveals the difference between standard price for the material purchased and amount actually paid for those. Okay, that is standard price minus actual price times actual quantity. So standard price minus actual price, that gives you a difference, times actual quantity. That will be the material price variance. However, the material quantity variance is a variance comparing standard quantity to actual quantity of material that you need to use. Variation is measured at the standard price per unit. So it's a standard quantity minus actual quantity times standard price. And that gives you material quantity variance. That means how much material did you use? Did you use more material or less material? If you use more material than standard quantity, then looks like your material quality is not good because you are using more material to achieve your goals. But sometimes the quality is good, is the same exact quality that it's supposed to be, but you are paying more money for it. And you want to know, okay, how much more money am I paying for this while I am using the standard amount of quantity that I'm supposed to use? I'm going to write this in a paper and tell you how to do this in an easy way. And let me see. Do I have? Yes. Okay. Okay, so I'm going to show this calculation on paper so you learn, and this way you can just do it very fast and easy in my class to solve problems, and also in a CPA examination situation in case you are going to become an accounting major and you want to go for CPA exam. The way I do it, it is very efficient, very fast, easy to understand, easy to remember. okay? But otherwise, if you look at this picture, honestly, you might spend a lot of time and you still get confused at the end. So let's see, what is this case study? I need to read it because case studies, normally you need a good reading about it. Okay, let's read it so I can explain it better. So in this case study, it says Blue Rail produces handrails, and the primary raw materials is 40-foot long pieces of steel pipe. Keep that in mind. The pipe is custom cut and welded into rails like that shown in the picture. Okay, got it. In addition, the final stage of production requires grinding and sanding and final coating of paint. Got it. Blue Rail measures its output in sections. Each section consists of 1 post and 4 rails. Okay. The sections are 10 feet in length and the posts average 4 feet each. So the section is 10 feet long and post is average 4 feet. Okay. It's the height of the post. Okay. Some overage and waste is expected due to need for an extra post at the end of the set of sections. Faulty welds and bad pipe cuts. Okay, got it. So there are some spoilage. The company has adopted an achievable standard. Write it down. 1.25 pieces of raw pipe, which is like 50 feet, per section of rail. So 1.25 pieces of raw pipe, which ends up to be 50 feet, per section of rail. Okay, during August, Blue Rail produced 3,400 sections of railing. 3,400 sections of railing. Every section needs 1.25 pieces of raw material, which is about $50 feet. Remember, the material is 40 foot long. So you need more than 40 foot. So you need 50 feet, which is 1.25. Okay, it was anticipated that pipe would cost $80 per 40 feet piece. Standard material cost for this level of output is computed as follows. So 3,400 number of rails. Standard quantity of input per rail is 1.25. That means one rail is 40 foot, but we need 1.25 piece of pipe in order to get the job done, which equals to 50 foot, 50 feet. Okay, standard quantity ends up to be 4,250 pieces of rail sections to achieve that production that they want to do. So standard quantity of input, we need 4,250 pipes to achieve this output. Very good. Standard price is $80. So standard cost is $340,000. So far, so good. Keep this in mind. This is your standard information. Now, the actual situation is this. Actually, the production manager was disappointed to receive the monthly performance report revealing the actual material cost of $369,000. Look at here, the standard was $340,000, but the material cost ends up to be $369,000. And a closer examination of the actual cost of material follows. Actual quantity of input of pipes is 4,100. Actual price was $90. Actual cost of direct material ends up to be $369. Now, how many pipes standard you need to use? You need to use 4,250 pipes as a standard, right? And you need that much because you have a little bit of waste also. Remember here, we were talking about a little bit of waste. Here. Some waste is expected, right? You see that? No, because you have to cut here, cut there. So there is some waste. So what they did, even though they, in the standard format, they needed for the 4,250 pieces of pipes. However, they only purchased and used for the 100 pieces of pipes, which is technically good, right? However, they paid $90 more. And they paid $90. That means $10 more than standard cost. And the actual cost overall ends up to be $369,000, which is disappointing because manager went over the standard cost calculation. So the total direct material, you want to know in this calculation, you want to know how to do it. I'm going to teach you right now. It will be a piece of cake. You want to know how to do it, and you want to understand what is the difference in regards to analyzing this outcome and what is the actual problem. Okay, so let me try this by, if I stop sharing for a second and I use my camera, but I'm gonna use my desktop camera, so that will be focused on my paper. There you go. And I'm gonna at the same time, I'm gonna turn on the ebook again. Okay. And look at the expenses that I have in the ebook. So I can show you on my paper. Here we go. Okay, this is how you do it. You write AAA, triple S. Okay, AAA, triple S. And then you start with quantity, price, quantity, price, quantity, price. And then you attach those sections like this. So far, so good. AAA, triple S, QP, QP, QP. Now, standard price in our example was $80. Okay, standard price, $80. Standard quantity is 1.25 pipes times 3,400 sections. And that ends up to be 4,250 sections needed. Okay. However, the actual quantity was for the 100 given in your ebook which case study we just covered. And actual price was paid $90. And the actual quantity was again 4,100. So as you see, you plug in all those numbers over there, and then you calculate to see what is this, calculate to see what is this, and calculate to see what is this. So 80 times 4,250, that's $340,000, and as a standard cost. However, 80 times 4,100, 80 times 4,100, let me calculate that. 80 times 4,100, that's 328,000. 328,000. And 41 times 900 is 369,000. Okay, so far so good. Sometimes you have this 369 given to you, which is technically makes your life easier, okay? Because you don't need to multiply this because it's already given to you. But this one, you need a calculator to do it. This one is also standard cost, which again, you have to multiply that to get that number, and then times price, that gives you the standard cost. Now let's attach these two and attach these two, okay? So 340 minus 328,000. 340 minus 328,000. How much is that? $340 minus 328 is 12,000. $369 minus 328. 369,000 minus 328,000. It's 41,000. So far, so good? Easy? Now, watch what I'm doing now. I'm saying SS standard. SS standard. As a standard, my cost was 340,000 here. A, actually, I paid 328. So standard SS, standard was 340. A, actually, I paid 328. That was less than standard, so that's a favorable situation. Now let's look at this one. AA. Actually, I spent 369, which standard was 328. One more time. AA. Actually, I spent 369, which standard was supposed to be 328. So actually, I spent more than standard amount, and that's unfavorable. So now here I have $12,000 favorable. This is 41,000 unfavorable. But what is this exactly? Now look, compare these two numbers at the top. Here, the price is same. You see, same price, standard price, standard price. The only difference is the quantity, because here it says actual quantity, here it says standard quantity. So when you are comparing these two numbers, because the price is same and you are comparing the quantity, so this is material quantity variance. Material quantity variance. Now let's look at this one. In comparing these two numbers, if you look, actual quantity. So quantity is the same thing, nothing different. But the price is different because here says actual price, here says standard price. So here we are talking about material price variance. So what's going on is this. They spend more money because material price variance is unfavorable. So they spend more money and they bought expensive material. However, that expensive material, even though provided for the 1,000 unfavorable situation, but the quality of the material was good. And it was favorable quantity used in the regards to material. That means quality was good. So it was a very good quality material, but up to $12,000 favorable outcome. However, the price was way too high and it was $41,000 unfavorable. So you have to tell to purchasing manager, say, hey, you bought expensive material, even though you claim it has a good quality. Yes, it is. However, the outcome from favorable outcome of good quality material was only $12,000 favorable in compared to spending $41,000 unfavorable in regards to price. So please don't buy this material again, because we end up by losing money instead of, let's say, saving money. So here is the difference: 12,000 favorable less 41,000 unfavorable. So 41 minus 12, that is 29. So $29,000 unfavorable, and we call this total material spending variance. Cool? Yeah? Okay. So if I stop the camera for a second and share my screen, you will see that the same information is in here. This is how your book is explaining it, right? And this is the way I do it. The way I do it, it's it's very easy. You can do the whole thing in about 40 seconds. And you can then have all the necessary information to respond to any multiple choice question that you might receive because of this type of case study, right? So yes, you spend about a minute to do this, but after 1 minute, you have all the information to be able to answer questions, analyze it properly, and any question comes up, I have the answers. So this is how your book is doing, and this is how I'm doing it. You judge, and you can use either way, it's fine. So in regards to journal entries, a company may desire to adopt its general ledger accounting system to capture and report variances. Do not lose sight of the very simple fact that amount of money to account for it's still money that was actually spent, which is $369,000. To the extent the price paid for material differs from standard, obviously, the variance is debited, which is unfavorable. or credited, which is favorable, to material price variance account. This results in raw material inventory account carrying only the standard price of material, no matter the price paid. So this is how normally they do the journal entry. The raw material inventory will be debited for $328,000. Raw material inventory, okay, and the price they paid for it, the material price variance, that's for the $1,000. That goes, which is coming here, material price variance. That goes in material price variance as a debit, which is unfavorable situation. And you know why debit is unfavorable situation? Let's say you say, oh, how do you know that? Remember, what's the normal balance for expense? Normal balance for expense is debit. So here, that's how I know material price variance is a debit. And accounts payable, it is credited for $369,000. So yes, they're gonna pay $369,000, but the raw material inventory was only debited for the actual quantity that they purchased based on standard price. So raw material inventory went up for the standard price multiplied by actual quantity. Where is this $328,000 coming from? You might say, how did you get that from? Let me show you my paper again for a second. Stop sharing. You see here, the $328,000. That is the standard price, because you always want to put the standard price in the raw material inventory, right? So we put standard price in the raw material inventory multiplied by actual quantity of material purchased and used. There you go. And remember, this is purchased and used, okay? Don't mix it up with purchased more material and used less. That's another story. But for now, we are talking about purchased and used all of it. So we purchased based on standard price of 80, and that's what it goes into raw material inventory. And accounts payable is $369,000. Yes, accounts payable is $369,000 because you paid $90 per pipe. So yes, your accounts payable is $369,000. But what you want to put in the raw material inventory as a form of debit to increase the raw material, that's just based on standard price, okay? So here we put $328,000 in the raw material inventory. The rest goes in material price variance as an unfavorable situation, extra spending for the material. And accounts payable will be $369,000. This way, always your raw material inventory is showing the standard cost of the raw material, no matter what. Now, work in process is debited for the standard cost of standard quantity that should be used for the productive output achieved. No matter how much is used, you always gonna do work in process debited for the standard cost. Any difference between standard and actual raw material usage is debited if it's unfavorable or credited if it's favorable to material quantity variance account. So now we are going to put in the work in process inventory $340,000. And raw material inventory, we credit it for $328,000. Remember here we put raw material for $328,000 in the inventory to increase the inventory that we purchased. Now we take that inventory of raw material out and put it in the work in process. So we take $328,000 out from raw material inventory, and we put $340,000 in the work in process. The difference is the material quantity variance of $12,000, which was, now you see it's on the credit side, and that's a favorable situation. So material quantity variance on the credit side is a favorable situation. You like that. And you might say, how do you know it's credit side is a good thing? Just like revenue. What's normal balance for revenue? What's the normal balance for gain? Credit. So here is material quantity variance is on the credit side. That's a good news. That's a good thing. That's favorable situation. So one more time, where is this 340 coming? 328 and 12,000. So 340 goes into work in process because that's based on the what actually went into the work in process. But how much material you are taking out of the raw material inventory? Just 328. The rest is just a favorable situation in regards to spending less for the inventory and having better quantity, better quality of material, and that gives you $12,000 favorable outcome. So those numbers are coming from here again, if I stop sharing, and right there. So this is the $340,000 that I was referring to, $340,000. And here is the $12,000 favorable outcome, right? So you take $328,000 from raw material inventory. $12,000 is the favorable outcome. That's why ends up to be 340. And here it's, so work in process goes up by 340,000 as standard debit for standard situation. However, you took only $328,000 of raw material as a form of credit. The rest comes from the favorable outcome of material quantity variance, $12,000. So you take less from inventory, but you put more in the work in process. How is that possible? It's a magic because you have a $12,000 favorable outcome. And that's all coming from the picture that I have in this calculation on the paper. So here is a key account view. So the entry to record transfer of materials to work in process. So in accounts payable, yes, we have $369,000 liability to pay for the material we purchased, very expensive at $90 per pipe. However, the raw material is just debited for $328,000, and the difference went into debit side unfavorable. We call it material price variance because we spend more money for the material that was supposed to be $328. We spent $41,000 more, which is unfavorable. However, when we go to work in process, we put only $340,000 into work in process by using $328,000 of material. How is that possible? Because we have a magic in here, a very good news, a favorable situation. And that's $12,000 saving in regards to having a very good quality material, quality of raw material. And that good quality of raw material provided us a favorable situation. Now we can do the same thing in regards to direct labor, okay? So this is how your book is showing. The labor rate variance is a variance that reveals the difference between the standard rate and actual rate for the actual labor hours worked, which is technically standard rate minus actual rate times actual hours. That gives you labor rate variance. How about labor efficiency variance? That's a very important wording, so be careful on that. Labor efficiency variance means how efficient your labor are working. If they spend less time than standard time and do the job perfectly, then there is a labor efficiency variance. A variance comparing standard hours of direct labor to the actual hours worked, measured at the standard rate per hour, which is standard hours minus actual hours times standard rate. So if your workers spend less time to do the job, they are very efficient workers. If they spend more time to do the job, then they need training. They are not efficient. So this is a case study again. It says there is an output of rail sections, 3,400 sections, and we spent $30, 30 hours per rail station. That means we need 10,200 hours of direct labor necessary to get the job done for 3,400 sections, and times $18 labor cost in average, that will be total direct labor cost of 183,600. But in reality, this is what happened. In reality, the actual hours was 12,500 hours. Look at the actual hours needed, 10,200, and here they used 12,500 hours. But the labor cost is $14. That is much cheaper than standard cost. So it looks like, just as I see, looks like they hired less efficient labor, cheaper labor. However, the cheaper labor ends up by using more time because they don't know what they are doing. They get paid less, but they spend more time. But overall, the actual cost ends up to be $175,000 compared to standard cost of $183,000. So yes, the overall cost was less, but you want to analyze it to see why that happened, right? So in order to do that, here is the calculation. And now I'm going to do it the way I do it and see if you can use it, you like it, or otherwise you can just use this. In my way, I never forget what I'm doing, but this way, honestly, I will be easily confused. And in the middle of exam, this is the last thing I want to be. I don't want to be confused. I want to have 100% confidence in what I'm doing, right? So this is how I do it. See if you like it or not. Here we go. So I'm gonna turn on the camera. I will do, I will stop sharing. Okay. And I'm gonna do the same thing one more time in here. Ready? So here I'm gonna do one more time. AAA, triple S. Good. Remember I said QP, QP? I can say Q, but I can, because this is about labor, I'm gonna, instead of Q, I'm gonna say hour, H. And for price, I'm gonna say rate because it makes more sense. But again, you can say QP, but I like to say for labor, I like to say hour and I like to say rate. Okay, HR, HR, HR. Attach those two. Okay. And then plug in your numbers. So let me have ebook on my screen some way. Okay. So the information I have in the ebook says that my standard rate is $18 per hour for the labor, and standard hours are 3 hours times 3,400 pipes, sections, I mean, 3,400 rail sections. So 3 hours times 3,400 sections, that means I need 10,200 hours. Okay. So standard rate is $18. Actual hours we used was 12,500 hours. And rate is, again, actual rate we paid is $14. And actual hours was 12,500 hours we used for this operation. So we multiply now. 12,500 times 14, that's $175,000. 10,200 times 18, standard cost supposed to be 183,600. So in actual situation, we spent 175,000, but standard was $183,600. But this one I have to calculate myself. So here we go. $18 times 12,500 hours equals $225,000. $225,000. Okay. So far, so good. Now we attach these two and we attach these two. And then 225 minus 183,600. So 225 minus 183,600. And that is 41,400. 41,400. So far, so good. The difference of these two is 225,000 minus 175,000. And that's $50,000 difference. Are we good up to here? Now watch. Very important, using those words all the time so you never make a mistake, okay? Here. SS. In a standard format, I was supposed to spend 183,600. Actually, I spent 225,000. So I actually spent more than standard. So that is unfavorable situation. Here, AA. Actually, I spent $175,000, whereas standard supposed to be 225,000. So I spent actually less than standard. So that is a very good favorable situation. Now, what do we call this? Compare these two numbers. Rate is same, standard rate, standard rate. Hours are different. So this is labor efficiency variance. Labor efficiency variance. However, here is actual. In an actual situation, you see here, I have actual hours and actual hours. So hours are same, but the rate is different. You see, here is actual rate, here is the standard rate, but actual hours are same, rate is different. Okay, so this is labor rate variance. Okay, so labor efficiency variance was 41,400 unfavorable. That means my labor force, they don't know what they are doing. They are not good. They need training. However, the rate that I pay them is favorable by $50,000. So because favorable, 50,000 minus 41,000 minus 41,400 equals $8,600. So the difference is $8,600. So because favorable is 50 and unfavorable is 41,000, so favorable is bigger. So total labor spending variance was favorable by $8,600. Labor efficiency variance was unfavorable, but labor rate variance was favorable by $8,600, more than unfavorable of $41,400. So even though my labor force don't know what they are doing and they need training, but I am paying them in a favorable situation, paying them less than standard pay. Now imagine management are aware of this and they can thinking, okay, let's keep this force, give them some more training, and here we go. We can make a magic and we can save a lot of money and create more revenues, spending less and generating more income. So let me stop the video at this point and go back to the book and see how it goes. Okay. So here is $50,000 favorable in regards to labor rate variance. And here is 41,400 labor efficiency variance, which is unfavorable. It's not good. It's the same result I got it into. And here is the journal entry that, how do we do it? So it says the company desires to capture labor variances in its general ledger accounting system. The entry might look something like this. So work in process inventory will be debited for the labor that standard format we need to spend. Okay, this is a standard cost. We always debit work in process for the direct labor for the standard cost. However, we have a wage payable of only $175,000. Okay, so we have less wage payable, but our work in process for the direct labor will be debited big time for 183,600, more than whatever we actually paying. And because this is the standard labor, we always want to put the standard numbers into work in process for material, for labor, for overhead. But labor efficiency variance, we have a 41,400 unfavorable situation. And remember, unfavorable is on the expense, on the debit side, just like expense. Normal balance is debit. So here is also normal balance debit. So if it's debit, it's just like expense, not good. We don't like it. It's not favorable. Make sense? But the labor rate variance was very favorable by 50,000. So we put it on the credit side. That means good news. That means like revenue, like gain. Normal balance is credit. Same thing here. We put it on the credit side. It's a good news. It's like revenue. It's like gain. It's like saving. It's good news, right? So the reason I'm repeating this stuff, so you feel it instead of just trying to memorize it. Feel what it means. When something goes on the credit side, it looks good. It's like revenue. It's like gain, normal balance credit. Something goes on the debit side, it's like bad news. It's like unfavorable. It's like expense. It's like loss. It's normal balance debit. So here we go. We debit this, we credit that. We debit the unfavorable and we credit the favorable for labor rate variance. And we credit wage payable for exactly how much we really paying. So we are exactly paying 175, while the standard was 183,600. And those numbers, again, it was on my paper, which is here. We are spending $175,000. Actually, that's what it is, wage payable. But we put 183,600 into work in process as a form of debiting work in process to recognize direct labor cost as a standard format. And because of these two numbers are not equal, so we have to debit labor efficiency variance T account for 41,400, and we have to credit labor rate variance for $50,000 because it's a favorable outcome. Cool. Okay. And here is the T account for you to see. So in the T account, we have work in process debited for direct labor, standard cost, 183,600. However, the wage payable is only $175,000. The difference is 8,600 favorable saving. But in order to reflect that saving, we put 41,400 unfavorable labor efficiency variance on the debit side. And we put credit of $50,000 because it was favorable labor rate variance as a form of saving on that part. And that is how the T account looks like after doing this journal entry. So for variable, for factory overhead variances, we normally look at the fixed expenses are normally fixed, not that much different. So, but we are focusing on variable factory overhead. So if it's unfavorable variance, this is what it goes. Supplies, that goes as not traceable, so that goes in overhead. Wage payable goes in overhead. Indirect labor, okay, indirect labor. Other expenses like factory, utility expense, all those type of things, or factory payable, let's say payables, anything that it's payable, like if you have prepaid insurance and you credit prepaid insurance, so all those prepaid insurance or prepaid rent or whatever, they will be credited and then it will be debited in the factory overhead. So factory overhead will increase largely, right? Okay. And then you, per predetermined rate, you apply the overhead into working process as application of overhead to the working process. And if there is some more overhead in here left over, then that will be unfavorable variances in the factory overhead, and it will be debited on that part. And as you see, here is a debit because it's too much. It's unfavorable. Just like expense normal balance is debit. So here, if it's a debit, that means it's unfavorable. So it's underapplied. So in this situation. But if after entering all those factory general expenses, like indirect labor, supplies, and other stuff into factory overhead, and then you use predetermined overhead rate to apply to the working process, and that's a little bit over-applied, too much in the working process using predetermined overhead rate, then the over-application has to be cleared and be recognized as a form of credit, because it's saving on the overhead. Actual expenses was less. It's a favorable situation, and you debit the factory overhead and credit variances. So we have also the same way I did that, the paper for material and labor. You can do the same thing for variable overhead spending variance, which is a variance that reflects the difference between actual variable overhead and standard variable overhead associated with the actual units of application base, like direct labor hours or direct labor cost or machine hours, whatever your activity base might be. Variable overhead efficiency variance is a variance that reflects the level of efficiency associated with the application of variable overhead to the production. So sometimes you are efficient in regards to managing overhead costs. Sometimes you end up by having a little bit more overhead than you're supposed to have. So this is a case study again. It says number of rail sections output is 3,400 sections of rail. Standard hours per rail section is 3 hours, and you use standard labor of 10,200 labor hours standard. And for based on predetermined overhead rate per direct labor hour, you have that $10 already calculated previously, and you know how, you remember how to calculate that $10, right? In order to calculate why is this $10, you say estimated next year total manufacturing overhead dollar amount divided by estimated next year total direct labor hours, and you get predetermined overhead rate dollar amount, let's say $10 per direct labor hour after that calculation. So estimated total manufacturing overhead divided by estimated total activity base. Let's say that in this case, activity base is direct labor hours. We learned that in previous chapters. Standard cost variable overhead, so it's supposed to be $102,000, right? So far, so good, but let's see what happened. Oh, so the total variable overhead variance is unfavorable by $3,000 because we spent $105,000 on variable overhead, which standard supposed to be 102,000. Okay, so this may lead to conclusion that performance is about on track, but a closer look reveals that overhead spending was quite favorable, while overhead efficiency was no good. So remember that 12,500 hours were actual working hours. That's 12,500 actual working hours. Since variable overhead is consumed at the presumed rate of $10 per hour, this means that $125,000 of variable overhead, actual hours times standard rate, was attributable to output achieved. Comparing this figure is $125,000 to the standard cost of $102,000 reveals an unfavorable variable overhead efficiency variance of $23,000. However, the efficiency was significantly offset by $20,000 favorable variable overhead spending variance of 125 versus 105. So let's see if I can put this stuff the way I do it. And so you can see that the way I do it is probably easier. So let me try, okay? Here we go. Let me turn on my camera and stop sharing for a second. So what I'm gonna do is, again, same thing, AAA, S. Okay, and because this is about overhead, and I'm doing overhead based on labor hours, so I'm gonna say labor hours compared to rate, hours to rate, hours to rate. Let's see if it comes right or not. Okay, here we go. Okay, so standard rate was, let me turn. Standard rate, I need the book. So let me open the book somehow. Okay, the standard was rate was $10 overhead rate, right? Standard overhead rate was $10, which was calculated and given to us. And standard hours, we spent 10,200 hours for 3,400 sections times 3 hours per section needed. That's why we have 10,200 hours. Okay, and if you multiply that, that's $102,000. So standard rate is $10, but actual rate was 12,500 used in this production. So that ends up to be $125,000. And actual rate, we don't know actual rate, what was that, but actual hours was 12,500 hours. And we spent $105,000. So here I don't know what the rate is, because technically we don't have actual rate. We always use the standard rate. So this rate is kind of blank because it's not relevant at this point. But I know that I used $105,000 overall for my overhead. Okay, $105,000, which was given in the book. It says total variable overhead variance is unfavorable by 3,000 because it was standard 102, but actually we spent 105. So let's attach these two sections together. So 102 minus 125 is what? 125 minus 102. That's 23,000. That's $23,000. And 125 minus 105, that's $20,000. Okay. Now, watch what I'm doing. SS, the standard supposed to be 102, actually ends up to be 125. So it's $23,000 unfavorable situation. Because standard was 102, SS 102 actually was 125. That's 23,000 unfavorable. Here is AA. Actually, I spent 105, but S standard was 125, so that was $20,000 favorable outcome. So what is this exactly? 23,000 unfavorable. So let's see. Here is standard rate is same, you see. Standard hours are different. Hours are different. So here is overhead efficiency variance. Okay, overhead efficiency variance. However, here, as you see, hours, actual hours. So hours are same, rate is different. So here is overhead rate variance. So here is overhead rate variance of 20,000 favorable, but overhead efficiency variance was 23,000 unfavorable. If you attach these two to each other, 23 minus 20 is $3,000. And because unfavorable is bigger than favorable, so that ends up to be unfavorable. That is total overhead spending variance. So total overhead spending variance was $3,000 unfavorable, yes. However, the overhead rate variance was favorable by $20,000, but overhead efficiency variance was unfavorable by $23,000. Cool. Okay, so let's now go back to stop the camera, go back to the book, and here we go. Those are the same numbers that I have for you. It's just given in here, and this is the way your book is doing. If you look at it, you will see that total spending is, let's say, 102. Actual, you spend 105, but you need to understand what's the favorable or unfavorable here. $23,000 unfavorable, that's overhead, variable overhead efficiency variance, and $20,000 was favorable, variable overhead spending variance. Okay. So here is the journal entry. So you're gonna go into a working process based on the standard cost. So standard was 102. Yes. However, you spend 105. So standard was 102, you spend 105. So you always put the standard in the working process as a form of overhead application. but factory overhead will be credited for 105, which is okay. But variable overhead efficiency variance was unfavorable by 23,000. That's why it's a debit. Anything is debit is not good, right? Debit, expense, debit, normal balance, expense, loss, all of that stuff is on the debit side. Gain, revenue, everything, good stuff on the credit side. So here, variable overhead spending variance will be $20,000 credited. And variable overhead efficiency variance will be debited as an unfavorable situation. And work in process will be debited only based on standard format of 102 for this type of production. And these numbers are, again, in the picture that I was showing. And fixed overhead, normally it's fixed, not that much change. Here says actual fixed factory overhead may show little variation from budget, not that much change normally. This results because of the intrinsic nature of fixed costs, which is fixed costs normally don't change. For instance, rent is usually subject to lease agreement that is relatively certain. Depreciation of factory equipment can be calculated in advance. That's normally fixed. The cost of insurance policies are tied to the contract again. Even though budget and actual numbers may differ little in aggregate, the underlying fixed overhead variances are nevertheless worthy of close inspection. So here we are looking at fixed overhead differences. Normally there is not that much difference, but anyway, there might be. So fixed overhead volume variance is compares the budgeted fixed overhead to the fixed overhead that is applied to the production based on standard fixed overhead part per unit of output. Fixed overhead spending variance is a fixed overhead variance that compares actual fixed overhead to the budgeted fixed overhead. Okay, so we have fixed overhead volume variance and fixed overhead spending variance. Okay, and in this scenario, let's see. The company had total fixed overhead of $72,000, but only spent $70,000. So they spent less. Normally, the budget is $72,000. So the objective is to allocate $70,000 between the work in process and variance accounts. Work in process should reflect the standard fixed overhead cost for the actual output. So work in process should reflect the standard fixed overhead. We always put the standard into the work in process, right? Assume that the Blue Trail had planned on producing 1,000 rails system during the month. 4,000 rail system for the month. Only 3,400 systems were actually produced, okay? So they were thinking about 4,000, but they did only 3,400 as we were using that 3,400 for last 1 hour. This means that the planned fixed overhead was $18 per rail, which is $72,000 divided by 4,000 planned railing system. That's like $18 per rail. Because 3 labor hours are needed per rail, so the fixed overhead allocation rate is $6 per direct labor hours, which is $18 divided by 3. $6 per direct labor hours for the fix, okay? As illustrated, $61,200 should be allocated to the work in process because we use 3,400 so-called we use 10,200 hours for the 3,400 rails. So where was I? So let's see. I lost my place. Oh, okay, let's read it again. 61,200 should be allocated to work in process. This reflects the standard cost of 10,200 labor hours that we use for 3,400 units of production, right? Remember that? So that's why we spent $61,200 as an allocation. Notice that this differs from the budget fixed overhead of by $10,800, representing an unfavorable fixed overhead volume variance. I'm going to do that also in paper so you can see it. Since production did not rise the anticipated level of 4,000 units, much of the fixed cost that was in place to support that 4,000 units was underutilized. For the blue rail, the volume variance is offset by the favorable fixed overhead spending variance of $2,000. So that $70,000 was spent versus the $72,000. Following is an illustration showing the cost. So let me do this again on the paper just for fun of it. And so you can see how to do that. And then we come back on this, okay? So let me stop sharing maybe here, turn my camera again, and do the same thing one more time, okay? So here we go. We do again AAA, triple S, okay? And then here we say again hours, labor hours, let's say, because we use hours, and then rate. Here is hours, rate, hours, rate. We attach those two parts together. Okay. And let me have my book back again on my screen. Okay, so in the book says we are using $6 for fixed overhead. So for fixed overhead rate, we use $6 per labor hour, and we spend 10,200 labor hours, and that's coming from 3,400 sections of productions times 3 hours per section labor. That's where it's coming from. So if you multiply that, and that gives you $61,200 application of overhead based on standard hours of production. But standard rate is $6 again, okay? Actual hours, we spend, I believe, let's see. The actual cost was $70,000, which is coming from actual fixed expense. It was given to us that we spent 70, in the book says we spent $70,000 of actual expenses, whereas because this is about fixed overhead, so the fixed overhead is always normally thinking that they're gonna produce 4,000 sections. That was in the budget, 4,000 sections, okay? But 4,000 sections, that every section takes 3 hours, as you see also in here. So in the budget, they were thinking they're gonna do 4,000 sections, and normally that's 3 hours. So that's about 12,000 labor hours in the standard format, that not standard format, but what they were planning normally to do in that period of time. So they were supposed to do 4,000, but they didn't do 4,000. They did 4,000 sections. They did just 3,400 sections. So it's different than what happens in that period of time. They were thinking about 4,000. So the 4,000 times 3 is 12,000, and 12,000 times 6, standard format, they're supposed to spend $72,000 standard fixed overhead expected, right? Not standard, but expected. It's better to say expected. So expected fixed overhead was supposed to be 72,000, but actually they spent $70,000 actual fixed overhead. So the actual fixed overhead, they spent $70,000. Expected overhead was about 72,000, but for this period they have this much production. So per fixed overhead of $6,000, that's $61,200. So if you see the differences, let's see how it goes. 72,000 minus 6,000, 72,000 minus 61,200, that's $10,800. That's $10,800. And here the difference is $2,000. Okay. So in a standard format, they spent $10,800, but the expected was $72,000. So that is, let me have a look at $10,800 of fixed overhead volume variance, and that's unfavorable because they had less volume. You see, the volume was 3,400 sections production, while they were expecting to have 4,000 sections of production. So the production volume was low. That's why they call it fixed overhead volume variance by 10,800. And this $2,000, that's fixed overhead spending variance. And that's by $2,000, which is favorable because they had, based on 4,000 sections of productions, expected overhead was supposed to be 72,000. However, actual fixed overhead ends up to be only $70,000, and that was $2,000 favorable situation compared to expected one. However, based on the only production of volume of less than 4,000, only 3,400, we had fixed overhead volume variance of unfavorable of 10,800. So that technically is the situation for the fixed overhead. Overall, spending variance in this situation is less. Fixed overhead spending is a favorable, $2,000 less than expected, but the volume of production was less, and because the volume is less, the cost ends up to be still unfavorable, because considering that the volume is lower for such a low volume, like this, the cost was supposed to be, a little bit more under control. So the fixed overhead volume, the volume of production was lower compared to the dollar amount of the fixed overhead that they spent, because they were supposed to do 4,000 sections production and end up somewhere between, let's say, 72,000, right? And but the volume of production was much less, and that's why that's a unfavorable situation in regards to the volume of production. So the fixed expenses overall, as you see, it's a little bit complicated. Normally, it might not be material difference, but if it is, that's how your fixed expenses, you kind of compare to it. In regards to CPA examination, you're not gonna get fixed expense volume analysis type of questions, or even in my class. In my class, most probably you will get somewhere in regards to material variance and labor variance, but not about fixed overhead variances, because that's very, most of the times, not a material number, or even it's very little differences, as it says also in this example, that it says here, little variation. So this is the T account that again says the factory overhead will go up and up and up because of all those untraceable expenses. And then it will be applied as a, based on the units of activity, it will apply to a work in process per $6 per hour of labor, which is 10,200 hours times 6. Here, 10,200 times 6, it goes into the work in process. However, the difference, extra 8,800 on unfavorable situation. Did I finish my, let me just, oh, here, let me finish this. So this, the difference is 10,800 minus 2,000. This is unfavorable, this is favorable, so that's 8,800 unfavorable. Okay, overhead spending. Okay, that 8,800 difference, unfavorable. Now let me stop my camera and show you the book that I'm looking at. So that 8,800, that's where the difference is. And that extra overhead application needs to go somewhere. We don't want to put it more than we're supposed to in the working process based on direct labor hours that we actually work. So the extra goes to fixed overhead volume variance, 10,800 in fixed volume overhead variance as a debit, because it's unfavorable because the volume of production was low. So that was unfavorable. But fixed overhead spending variance will be $2,000 credited, and that's where the difference of $8,800 is going. So 2,000 over there and 8,800, 10,800 in here. That's a credit, that's a debit. The result is a credit of a factory overhead. So the journal entry is debit factory overhead volume variance 10,800, which is a bad thing, and then credit fixed overhead spending variance 2000, which is a good thing. And then we credit factory overhead for the difference. So the factory overhead ends up to be 0 at the end of the period. And that's the journal entry. So work in process will be debited only for 61,200. Overhead was actually $70,000. That cost us right here. Okay, so for that cost, we credit factory overhead for $70,000, which is combination of these two numbers. Okay, so the factory overhead becomes 0. Very good. 70 here, 70 there. But when you take 70 here, you cannot put 70 in the work in process, because work in process based on only 3,400 sections production, total 10,200 hours of labor times 6, that's 61,200 only in the work in process. So factory overhead volume variance, that's an unfavorable situation for 10,800 based on my paper calculation, and 2,000 it is fixed overhead spending variance. So let me show you my, stop sharing here 1 second and show you my paper one more time. And here is the 61,200 that goes into the work in process. And that is fixed overhead volume variance of unfavorable debit. And then this is fixed overhead spending variance of $2,000 credit. And we debit the factory overhead, we credit the factory overhead for a total of $70,000. This is just to make the factory overhead become 0. So the factory overhead becomes 0, but how much goes to the work in process is this much. The rest goes a little bit to the fixed overhead spending variance as a form of credit, and then as a form of debit to fixed overhead volume variance. So let me stop this one more time and go back to the book, and you will see that journal entry right there. Hopefully it makes sense. Again, in my book, in my class, and in CPA exam, you hardly get a question like this in regards to fixed factory overhead variances. And here is the recap again. So the direct material actual cost was $369,000. Standard cost assigned to work in process was $340,000. Overall variances was $29,000 in regards to direct material. Out of that, $41,000 is price variance and $12,000 is quantity variance. Price variance was unfavorable. However, the quantity variance was favorable per the calculation that I did for you already on the previous paper, which I have it right here in front of me. Yeah. So let me show you this again on the paper that I did. So here is the $41,000 unfavorable direct material price variance, $12,000 favorable direct material quantity variance, and total material spending variance was $29,000 unfavorable. Same thing on labor. Actual cost for labor was $175. Standard cost was $183. Overall variance was $8,600 favorable, but we have rate variance of $50,000 and labor efficiency variance unfavorable of $41,000. That's why we overall end up to be in a favorable situation for direct labor. variable factory overhead. The actual was 105. Standard cost supposed to be 102. So that was $30,000 unfavorable. And fixed factory overhead was actual cost 70. Standard was 61,200 for the production of 3,400 sections. So that's overall gave us $8,800 unfavorable variance in regards to actual cost, because the standard maximum we can apply for the 3,400 sections of productions is only $61,200, but actually it cost us more compared to our 3,400 sections of productions. Cost us $70,000. That's not good. That's $8,800 overall unfavorable variance for a fixed factory overhead. Okay, so the $719,000 was total actual cost for the material, labor, variable overhead, and fixed overhead, and the standard cost was $686,800 aggregate total. Then the difference, as you see, the actual was $32,200 negative or unfavorable for aggregate cost of direct material, direct labor, variable overhead, and variable fixed overhead. So as you see, material was not good, labor was good, and also overhead was not good. Those two are in red. Okay. As I said, this chapter 22 was technically 2 chapters in a regular book format. So that's why it is a little bit long. Even now we compare this balanced scorecard, maybe you can even say it's close to 2.5 chapters of book. So balanced scorecard is a set of performance measures that are congruent with assessing improvement in financials, customers, business process outcomes. So you create a balanced scorecard to make sure that all these 3 things are working properly. Because you have a finance section, you have the process of the business operation, you need to have a good amount of learning, growth, and training for your workers, and your customers will be happier if they have more trained customers. So more trained workers. So more trained workers will increase the efficiency of the business process and operation, and that will increase the good business and efficient business operation will increase the financial outcome, better income statement, better balance sheet, and better income statement, better balance sheet will also help customers to be happy because they can get much more competitive pricing and better customer service, better warranty service, and everything goes hand to hand. So all these 3 things are constantly related. Good employees give you better business operation. Better business operation gives you better financial income and financial statements, better income, higher profit, and that will end up again to have happier customers because of efficient business service to those customers. And that's it. Chapter 22 is done. Next time we will cover chapter 23 for you.